Hey guys, it's Steven from Mills Wealth Advisors. I'm creating a follow-up video to my most recent article called Is There Value in Value Investing? And in this, wanted to talk a little bit about some of the research that was done behind the scenes and walk through a couple of different slides. We had a number of people ask some questions about where the research came on that, if there is still value in value investing. And so let's get right into it and talk about it. So this right here is a graph that's showing the price to book ratios of value stocks versus growth stocks. And I want to talk about a couple of different areas. So this olive line right here is the average growth price to book ratio going back to 1926. The gray line is the average value stocks price to book since 1926. And then this light blue is the actual growth price to book, and then the darker blue is the actual value price to book. So when people look at this slide, there's usually one thing that pops up first, which is here in the year 2000 or 1999, when we had the highest price to book ever. And then the second thing that people look at is over here where we're at in today's world, which is near that all-time high. And so some people will ask us and say, well, are we close to a bubble bursting? Are we worried about the price to book currently of growth stocks? And the one thing that I think differentiates these is if you look at in 1999, the 10-year treasury was 5.65%, while in 2020 it was 0.89%. So obviously a 10-year treasury is when you buy a bond from the government for 10 years and they're going to pay you a stated interest rate. So in 1999, you could buy 10-year bond that would be paid by the government, pretty safe, for 5.65%. Whereas in 2020, you could only get 0.89%. So most people looking at that, they would probably not take the 0.89%. So what's happened is recently, as interest rates have fallen, people have been not investing as much in bonds. They've been investing more into growth stocks, into the S&P 500, which is heavily growth. And so what's happened is these price to book ratios currently are higher, but that's explained because the 10-year treasury is lower. And so there's less of a reason for me to want to invest in bonds. Really, I'm not investing in bonds right now for any kind of return. It's more for taking some of my money that's not going to be in equities. But there's a number of people who've decided that they were going to use growth or the S&P 500 as their safer investment. So that's a part of the reason why we feel like with stocks right now having higher price to book ratios than they did here in 2004 to 2007, we feel like that's okay because of what's happened with interest rates. We still would like them to be lower, obviously, but it's not as concerning as it was here. The other thing that people also notice is that right now you've seen this tick up as far as the growth price to book has been going up, while value has been fairly even, and then it's actually gone down and around its average. And we'll explain that a little bit more in the next slide. But what this tells us is that value hasn't had the same price to book growth, and so it's obviously something that's a little bit more fairly valued, and so it would make it even more appealing to be invested in. So this next slide is looking at the historical growth of value stocks versus growth stocks. Now, if any of you have spent much time talking to us, you would know that there's really three things that we believe strongly in, and it's rooted in evidence like this, that value stocks beat growth stocks, small stocks beat large stocks, and high profit stocks beat low profit stocks. And here, if we look at 1926 to 2010, 84 years worth of data, value did 12.8% and growth did 9%. So we can say that value beat growth by 3.8% for 84 years. Now in 2010 to 2007, we had value do 14.3% and growth do 16.6%. So in this 7-year period, value underperformed by 2.3 Now that being said, it had above average returns. If you look at this 7 years, 14.3, that is 2.5% higher, 1.5% higher than it was for the 84 years before. So it actually had above average returns. It's just growth had 16.6. Now if we look at the following 3 years after that, July 2017 to June 2020. Now a caveat is part of this has the pandemic in it, and what happened in the pandemic is value stocks got hit really, really hard. Growth stocks didn't get hit as hard. People were fleeing from risky stocks and they were moving into less risky stocks that are in the S&P 500, like Apple and Google and Amazon. And so we kind of have to take this with a grain of salt, but still, this is a 21.2% difference between the two of those. So for 84 years, value beat growth. For 7 years, growth kind of beat value. And then for 3 years, growth crushed value. So if we look at this over 2010 to 2020, we have 9.02% return for value, and we have a 16.99% return for growth. So growth did well above its all-time average, and value did a little bit below its all-time average. Now if we look at this a little bit further and we go back and look at the last 2 times that the value premium, meaning value usually beats growth, so we call that a premium. If we look at the last 2 times that happened, it was in 1930 to 1939 and then also 1990 to 1999. So in the 30s, value lost by 5%, 4.9% to growth. The following 10 years, from 1940 to 1949, value outperformed growth by 10.3%. If we look at what happened in 1990 to 1999, value lost to growth by 3.1%. The following 10 years, from 2000 to 2009, it was 6.4%. So I want to point out this is the amount that it produced above growth. So this isn't the actual returns. This means over here that value lost by 3.1 and it won by 6.4, lost by 4.9, beat it by 10.3. I find it interesting that it lost by less and won by more. And so we have 2010 to 2019, there was a 3.9% loss of value versus growth. So what does the next 10 years hold, 2020 to 2029? If we look back at what we see in the past, we're confident that value will outperform growth over the next 10 years. And we've started to see that happening with value stocks over the last 6 months, outperforming growth stocks by a good amount. Now, some of you are going to be, well, that's nice. What do you guys know? This is coming from Vanguard. So this is Vanguard in June 30, 2020, and this is them talking about what they see happening over the next 10 years. So they're 10-year annualized return projections. These are projections, obviously, so we're projecting, they're projecting. We don't have much to go off of except for past experience. But if we look at the top 3 places that they're saying is going to have returns, first is US small cap. They're thinking a 4 to 6% return, and then value, which is 5 to 7% return, and right below it is US growth. It has 1.6 to 3.6. So we're talking about almost double the return expected for value over growth, and this is coming from Vanguard. And then they have the highest returning asset being global equities outside of the United States. So being emerging markets and also being developed countries outside of the United States. So this is coming from Vanguard. You see down here, source Vanguard Investment Strategy Group as of June 30th, 2020. Now if we look at also what they believe there's a positive international outlook over the next 10 years. They expect non-US equity annualized returns to be 3% higher potentially in non-US versus US. And so going back to one of our big beliefs is having a diversified portfolio, not only value versus growth and small versus large, and high profit versus low profit, but also having some of those non-US equities, which has not been a good investment in the 2010s. But we believe, and Vanguard both believe, that value is one of the better places to invest inside the US, and also that developed international as well as emerging international are good places to be invested. Now, this could all very well be wrong, and we realize that, and so we're not putting all of our eggs in one basket and only investing in value and only investing in small and only investing outside of the U.S. Our portfolio right now is 50% inside the U.S., 50% outside the U.S., and we've got some value, we've got some growth, we've got some high profit. We're trying to buy the whole market, but then investing extra versus what most people are investing in these places that we see are going to have higher returns, which according to us and according to Vanguard would be international investments as well as value. So wanted to just go through this, help explain my article that was, is there still value in value investing? We believe there is, and we also believe there's value in investing outside of the United States. If you have any questions, feel free to give us a call, 817-416-7300, or feel free to get on our website and send us an email. Happy to talk with you. If you're a client, we'd love to talk to you about your portfolio. If you're not, we'd love to talk with you about how we can help you have a more enjoyable investment experience. Thanks.